Welcome back to All Things Money. I'm David Blain, and for this final segment, we're going to wrap up a few things on investor sentiment, and then we're going to get to a couple of emails and letters that we received. The first thing, the previous segment, we were talking about investor sentiment reaching peaks of extreme optimism as well as peaks of extreme pessimism. One thing that I want to point out is this is not a science where you can say exactly, well, that's too many people are optimistic or pessimistic, that these peaks in optimism obviously change over time, and you can only determine a peak or trough in hindsight. But so I don't want you to get lulled into a false sense of security that you can exactly time the market with this, because each peak may be successively higher or each low may be lower. For example, the low that we reached in March of 2009 was the lowest sentiment reading of either of these polls that they had ever taken. And so if you had gone by a previous low in sentiment, and I think they got down to something like 30% optimistic. So if you had gone with, well, when the market gets to, 50% or below optimistic, you would have been very early. But the point is that it still can be used as a great tool to help determine your investment strategy. So I want you to get familiar with sentiment, and I want you to use it. But once again, like everything, you should use it in conjunction with other indicators. So let's move on to some of our reader mail. A listener from Oriental writes, my wife's mother is in a nursing home, and we're considering a reverse mortgage on her house to help pay for her care. Can you talk about the pros and cons of reverse mortgages? Well, that's a great question, and one that 10 years ago you never heard because people didn't do this. Well, it's something that's come to light recently, and for those that qualify, it can be a good thing to use, however, with some caveats. The first thing to realize is that there are some age requirements to do this. And so it's something that you don't want to consider until you're later on in your years. But some of the benefits is, first of all, it allows a person to stay in their home permanently. And so if someone is living on a fixed income and they're having a hard time meeting it, but they have a lot of equity in their house, instead of selling their house and trying to move to a lower cost location, what they can do is they can set up an arrangement with the bank, and it's called a reverse mortgage. And essentially, instead of you paying a mortgage to the bank every month, the bank pays you. And so it can be a source of income. And so the benefit of it is that you can stay in your house permanently, and you receive income every month through this mortgage. Some of the other benefits, even if you have an existing mortgage, depending on the value of your house and the current lending standards, a reverse mortgage can actually pay off the rest of the mortgage that you may owe. And so that can be a real benefit. So let's say you have, $50,000 remaining on your mortgage. The bank could pay that off as well as send someone a check, for $500, $600, $1,000 a month or whatever. That's all determined by the value of your house, the current interest rates, how old you are. There are a number of factors that involve, but suffice to say that even if you have a mortgage, you still could be eligible for this program. They're very easy to qualify for because you don't need a credit score or income. The idea of the reverse mortgage is that you don't have enough income, and they know that, and so you don't have to qualify on income. You're not paying money back, so you don't need a good credit score. Well, it comes down to the value of your house and interest rates, and if you have equity in your home and the bank is willing to lend it, more than likely you can qualify for a reverse mortgage. As I already said, there are no payments for this. That you are receiving payments. It can be either a set fixed amount. You can set up a credit line for access in emergencies, or you can receive a lump sum. And then you can go invest that money and create your own monthly payment. Depending on the taxpayer's circumstances and their risk tolerance, each one of those situations may be appropriate depending on the person as well as the house. One other benefit of this for the people that ultimately inherit or would inherit the house, there's no way to get upside down in the house. Sometimes we see if elderly people mortgage too much on their house and then they die, they actually owe more than the house is worth. So this cannot happen with a reverse mortgage. That's another benefit. The heirs will inherit the home if that's important. They can inherit the home, and any remaining equity after the balance of the mortgage is paid off, they could keep the home. So there are a number of scenarios that when the person that took the mortgage out passes away, that would either enable the heirs to keep the home if it was something that had been in the family for a while, or they could let it go. The interest rate is traditionally lower than your traditional mortgage too, so there are some advantages there. What are the cons on that? The fees are usually about the same, but some of the higher fees are usually found on the origination fee and the mortgage insurance. Social Security and Medicare are not affected by reverse mortgages, but some other need-based programs are affected by this. So if you're looking at your mom or dad and they're qualifying for some other program, having the income from the reverse mortgage or the lump sum may disqualify them from those programs. The other biggest con to this is it's not well understood by most people. And so they either think they're giving their house away completely, or they think it's a way to get free money and there are no consequences. So anyway, it can be a good thing if used properly and you fully understand how a reverse mortgage works. So we received another email from Mac in Morehead City, who keeps hearing about the commercial real estate bubble that could trigger another financial crisis that's as bad or worse than the last one. Is it true? The simple answer is, I don't know. Nobody does. What most people are referring to, maybe you've read it in the press or heard it on TV, most commercial mortgages are done on, say, 3 to 5 or maybe 10-year notes that are assumed to continually renew, that a lot of business properties that they never actually plan to pay them off. They just keep refinancing over the years and then eventually sell the property. And so what's happening the next year or two, we're seeing a tremendous amount of commercial mortgages are coming due that were originally taken out during the heyday, and people maybe have over-borrowed on the properties. And so that's the biggest crisis. Maybe we'll get into that a little bit more next time. But that's all the time we have for tonight. And so we thank you for listening to All Things Money. If you have any questions, feel free to email us at allthingsmoney@dlblain.com. Until next time, this is David Blain for All Things Money.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.